I'm John Lutzius. I'm Managing Director for Green Street Advisors in Europe. I've been with Green Street a little over 20 years. Our firm is focused on research and institutional brokerage in the listed real estate market. Our topic for this panel is, where is new financing coming from? And from my point of view, a story that really that illustrates the incredible dynamism of the financing market in Germany over the last 2 years or so would be the story of GAGFA. So only a year ago, we were staring at giant CMBS maturities for GAGFA, quite a bit of concern in the market about how that money might get refinanced, certainty among many people that GAGFA would have to make massive portfolio sales to help bring down the debt levels. Turn the clock to now, and GAGFA has refinanced over 4 billion euros of debt over the last 9 months. The rates have come in surprisingly sharp, and the stock is up 2.5 times from its 2010 low. So to me, that's a great way to illustrate just how dynamic the lending scene, how much more available debt has become. To broaden out the discussion and bring other views, we have a great panel. And I think it would be best if the panel just spends a moment, and if you could each introduce yourself, maybe starting with Michael.
Hi. My name is Michael Morgenroth. I'm CEO of CAERUS Debt Investments. A spin-off from Signa from July this year, and we are an investment advisor specialized on real estate mezzanine debt.
Matthias, Grund, partner of the finance department in the Frankfurt office of Kellner Gates LLP. We are involved in quite a few real estate financings, single transactions, but primarily portfolio transactions, and covering the whole range of the liability side of balance sheet in terms of the instruments advising on.
Jacob Lyons, one of the managing directors of CR Investment Management based in London. We cover a variety of countries in Europe, Germany being one of the major ones.
Curth, Flatow, FAP, a managing partner, Debt and Capital Advisory.
Jesse, Freitag-Akselrod. I am the director of Akselrod Consulting. We help companies in the listed space, or those who want to enter or improve their standing in the listed space, succeed in doing that.
Thank you, gentlemen, and welcome. The idea for this panel is 3 parts. The first part is to spend a little time thinking about the current landscape. Second is to break out the crystal balls and think about what might change. And then, time allowing, I'd like each of our panelists to talk about their best ideas. To kick it off, I'd like to just start with a quick overview, if I may, Curth, with the tone of the lending market. You produce something you call the FAP barometer, and it's designed to give your readership a sense of what's happening in the market. And I believe you published it last week, your fresh version. Can you just give us a sense of what you're seeing out there, please?
Yes, I'm pleased. Thank you. I mean, the barometer is a survey amongst lenders active in Germany, German and international lenders, banks, insurance companies, debt funds. We're publishing it on a quarterly basis. It's the first compressed overview on senior debt market analysis. And the fourth quarter it shows an absolutely balanced financing market. Over 50% of the lenders reported recent or continuous increase in new business. There were a few press releases during the last days. A real bank has doubled new business volume in the first 9 months. Pfandbrief Bank has raised business, and Berlin Hyp has raised their business by over 40%. So quite positive momentum at the moment. With average LTVs at 69%, average margins at 185 basis points for investments. So all looking pretty balanced in the market at the moment.
These conclusions sound similar to the University of Rendsburg recent study as well that talked about a lack of gaps in the financing market for prime assets. Is it a bit trickier for secondary assets in your view, Curth?
It is definitely trickier when it, in terms of locations. C and D locations might not that be easy to get finance. A or any core type assets, core location, that's pretty easy. Also up the LTV curve up to 70% or even maybe 75%. When it goes to B locations or let's say niche products like hotels and nursing homes, it's getting more difficult.
So just to
but not impossible.
So just to set the initial tone to kick off our discussion, very easy to get financing for the prime assets, a little trickier for the more difficult assets, and we have some expert commentary to help us walk through that. Before we get into too many details on the current financing environment, Matthias, could you give us just a few big picture comments? We had the situation a year and a half, 2 years ago, a lot of distress in the banking community. Now we're hearing from Curth a much more positive tone, the story of GAGFA being refinanced as well. What's changed? Who are some of the new players that have come in and added capital to this market?
I think we are in a transition period, so to say. I mean, as you said, there are no gaps in obtaining financing for prime locations. Also, I would say for small cap deals up to 30 million, it's quite easy to obtain financing for these portfolio deals or single transaction deals, whatever. It's also easy again for distressed situations because that's why I said it's a transition period, because the traditional sources of financing, including the banks, but in particular the banks, left the scene in the distressed market and increasingly left the scene, and hedge funds, opportunity funds, and other alternative sources of financing in Germany a lot. Families or family clubs, I call it, not institutionalized family offices also, but a lot of families who are organizing their investments themselves are filling the gap. But it's not that the expected refinancing wave has already came in a dimension that we are all flooded with these kind of financings. But I think that in the prime locations, the single assets deals, but also the distressed deals, new players have appeared on the market, including the big names like CAERUS, for example, Investec and others, but also smaller debt funds. What remains still a challenge are the deals which are in between the good quality and the distressed situations, where a lender has to really look into the situation. There's a lack still of linking up the local expertise and also the legal background and the feeling for the market locally, and the investors who are quite often with small teams located in New York or Boston or UK. It's clients of us who are urgently looking for the possibility to invest, but it's very still a challenge to bring these two worlds together in a way that it works very well to the benefit of the market.
It's an interesting comment. If I understand it right, it echoes a comment made by one of the earlier speakers talking about this barbell market where the prime is very easy. And then surprisingly, I think, Matthias, you're saying that some of the distressed is where there's a fair amount of new financing, but in that middle ground, it's harder to do. Very interesting. Jacob, if I may, from the standpoint of doing a deal today, so if a purchaser wanted to finance a portfolio, and let's just say it's a 100 million euro portfolio of good quality assets but not prime, can you give us a little bit of a sense of the menu of borrowing options, what a capital stack might look like, and what some of the pricing for that might be?
To some extent, I'd reiterate the comments that were just made. And one of the biggest issues, so beyond the sort of traditional senior banks in Germany, which are becoming more I would say not necessarily aggressive, but at least a little bit more open-minded, to the extent that probably a year ago nobody would look at a portfolio deal just because it was too complicated and there were enough single assets in good or high-quality locations. Now people are starting to look at portfolio deals. PBB being a good example of that. The issue, I suppose, with the capital stack is the same as the issue is everywhere, which is it's a bit like herding cats. So you're trying to get the borrower, the senior lender, the portfolio itself, and potentially a junior lender all into a room, all into the same dynamic, all at the same time in a very, very dynamic funding situation. And again, I would kind of underline this comment. One of the issues with capital stacks, especially with the sort of hedge fund, private equity fund community, is that in our view, they kind of split into two different groups, where there's one group, which is the group that's been in Europe for a number of years, Cerberus, Blackstone, et cetera, et cetera. Now, to some extent, they are actually handicapped by the fact that they've raised discretionary European funds in a lot of ways, because they have a lot of money that is just allocated to making those sorts of investments in Europe. Now, what that's, of course, driving is that's driving the check size. So they are, to some extent, constrained to looking at very, very large deals, and that's becoming an increasing issue as time goes by. On the other hand, you have the hedge funds, private equity funds, etc., that are sort of out of New York, Boston, Texas, wherever, who have put, maybe an ABS trader on the ground in the UK, maybe not even. So they might not even have a representative office. They're looking at portfolios because they have a segregated pool of capital within their US fund that can look at Europe. And they're looking at these portfolios and they're saying, okay, looks plausible, looks interesting. They'll send a guy over, they'll do site visits, they'll do due diligence, they take it back to the US, they look at it in credit committee and they say, well, I've never heard of any of the names of these places. Why are we making this investment? Let's go to Miami, Florida.
Right.
So there is, I would say, and you see this in the market, sort of 2012 was typified by, I think, 80% of the large-scale deleveraging deals being done by Deutsche Bank and Lone Star. I'm talking, sort of across Europe. This year, pretty much the volume in terms of large CRE deleveraging has more or less doubled, so sort of somewhere between 10 and 12. There's still only about 8 buyers. So there are the traditional players, and then there's a lot of noise.
Right. It's interesting to hear you say that some of the big U.S. Private equity firms are somehow constrained or disadvantaged by having big funds. And are you saying that it's getting harder and harder to find big deals to do?
Yes. I mean, to your question, I mean, looking at the kind of, I know it's sort of somewhat specifically imaginary, but looking at a 100 million euro portfolio, if you imagine that you get 50% financing from a traditional German bank, finding somebody to do 10 to 20 million of junior below that is pretty much rules out most of the private equity funds that have been in Europe for the last 10, 15 years.
Because the deal would be too small.
Yeah, much too small.
So if you wanted to do that, if you were looking for a 20 million piece, can you give us a sense of when you did find it, what it would cost, in your view?
Probably looking at a 10% IRR. That
high. Interesting. Michael, I know that you do some of this work through your fund. Can you give us a sense of the mezzanine story? I'd like to get into that in a little bit more detail, using either this hypothetical $100 million euro portfolio or whatever way you want to communicate it. But I'd like to get a sense of the pricing there, the opportunity that you see that you're pursuing with your fund.
Well, pricing is not really different from what my colleague just said. But it really, for us, it's really kind of core business to have these pieces between 10 and 30 million as mezz pieces. That's not only because the competition is maybe not as big as with the big tickets, but it's also kind of risk management on the exit side, because after a while you have to refinance the deal, or the deal has to be sold, or the property has to be sold. And keeping in mind that our slice maybe 20% of the capital structure times 5 is property gives property sizes between 50 and 150 million. It's easy to refinance. The circle of buyers is still big enough. If you get higher in the mezzanine slice, it's even harder to find refinancing coming to the exit. The story behind the development of ourselves into the mezz space, I used to work with Gotha Insurance Company in Germany, running the real estate side there for 8 years with my team. And I was very active in the discussions on the political side on Solvency II. And together with the regulations on the banking side with Basel III, that led us to the decision to just leave the insurance company and be self-employed in the mezz space, because that's not only a short-term trend for Germany, it's a real change in the refinancing world. So the US or UK have been experienced to having this kind of financial structures or capital structures. For Germany, it's totally new, because there was never ever any demand for that, because the banks were able to lend up to 85-90%. So there was no need for structured finance. That has changed dramatically. And as said, we are probably not the guys trading with prime, because the returns are too small to justify mezz returns. But we're also not the dirty boys. We're just the boys handling complex transactions and smaller transactions and B and C cities. And the demand there is really big. Costs of financing, as always, depends in the range between 8 to 15%, but roughly 10 to 12 is probably a good guess. And we are acting in a space between 50 and 80% LTV, was 60 to 80. Also depending on the kind of property. Office and retail is not that kind of a problem. Hotels, really difficult to find senior lenders. And anyway, there's a difference between the UK and Germany. In Germany, we don't have any problem on the senior side. There's enough senior lending available at very competitive rates. So it's just a question who's providing the gap, and that's where we thought that would be a good time to go into this business.
So, Michael, you sound pretty happy. You're finding sort of 10% and higher IRRs with loan to values in the sort of 70 to 80% range and relatively limited competition.
Right.
Interesting. I'd like to switch over and just talk a little bit about the listed market. And Jesse, I know that you're the co-author of a study that really helped the market see the size of the listed market, which I think some people have the wrong impression of. What were the key findings of your study on the listed market?
Yeah. So I think the listed real estate space in Germany often is understood as insignificant or irrelevant when you compare it to sort of the classic German open-end funds, closed-end funds, Spezialfonds. What we did is we wanted to take a look if that's true, and also test what does the listed space look like versus other international markets. So what our research showed is that the listed space really is not small by comparison to the open and closed-end funds. On the contrary, the listed companies of Germany jointly own gross asset value of about 68 billion euros. By comparison, you have open-end funds, closed-end funds, who combined own something like 69, 70 billion. So the German listed space by itself is more significant than the other two put together. I think the source of this confusion typically is that the open funds, the closed-end funds, would be assessed on the basis of gross asset value, whereas the listed space would typically be measured on the basis of equity market cap. So you have an unequal comparison, you don't have apples to apples, and of course this understates then the size and significance of the listed space. So indeed, I would say the listed space is quite significant as an indirect investment vehicle within the German market. By contrast, we have to concur with the argument that the listed space is indeed small by comparison to other European nations and, of course, internationally. So, for example, if you look at the free float market cap of Germany, that is about 25% of the free float market cap of the UK, about 50% that of the Netherlands. And when you take into account the much larger size of the underlying physical real estate market in Germany, I think that really exacerbates or accentuates the argument of underpenetration for listed real estate in Germany. That said, there is one sector, even in a pan-European context, where the listed real estate space is quite significant, the most significant, and that's the residential sector. So almost the entire residential listed market cap in Europe is contributed entirely by German companies, which also by extension says that they contribute almost nothing to the commercial. I think from the perspective of the significance of the residential sector, you can also see that in the last year's issuance volumes, we had record combined debt and equity capital markets issuance volumes, almost 3 times the volume of 2012. And that it came to about 10 billion euros in debt, equity, various instruments flowing into German real estate through capital markets. And that was 98% contributed by German residential companies. So there's certainly a strong disconnect there between the relevance of the different sectors.
So the listed market in Germany is maybe a lot bigger than you may realize, but it's mostly all resi. Question on innovations on the listed side with resi. Deutsche Annington, very interesting company. They've been accessing capital in some very innovative ways. What are some of the things that they've done recently?
Yeah. So as a quick backdrop, Deutsche Annington in August 2006 had about 6 billion, just shy of 6 billion in CMBS issuance. The global LTV at the time was just above 84%. So from my perspective, from the current vantage point, very highly leveraged. Other companies obviously were issuing CMBS at the same time. Certain of them went public. Deutsche Annington sort of stayed in the private market, and as maturities came up in 2013, there were several things that this company did and had done to really masterfully use debt and equity capital markets to do its refinancing. In the first instance, the company had plowed back cash flows consistently, sold assets consistently over the time between issuance of the CMBS and maturity. So the LTV on the original valuation had been brought down from somewhere in the mid-80s to somewhere in the low 70s, which by itself is already a pretty decent achievement. And without going into a lot of detail, the company was able to corral sufficient of the note holders of the CMBS, and through a series of complex negotiations, transactions, was able to get an extension of the CMBS paper, which gave them enough breathing room to then access capital markets to do an IPO and to access unsecured bond markets. And this is really an interesting topic in Germany. There's no other German property company which has ever accessed unsecured debt. So looking at Deutsche Annington specifically, you have this company, 84% leverage in 2006. does its homework, pays down debt, negotiates with bondholders, does an IPO, accesses a new market segment in the bond market, and come 2013, this company is at 51% leverage, has an investment grade rating, and is prepared for future growth. So I think here's an example of a company that's really understood capital markets, used them properly, and has opened up for the rest of the participants really a new segment of great interest in this benchmark bonds segment.
It's interesting. It's something like €1.3 billion senior unsecured debt in Europe, and then a further $1 billion sold in the US. So accessing capital in a very innovative way. I wanted to ask Jacob, if I may. You obviously have great depth of knowledge of the German market, but you're based here in London. Any one or two things that really strike you as you look at the German market, how it's different and unique and different than what you're seeing in other markets that you compete in?
I would say that there are two absolutely critical things which are driving it. I think the first is the existence of the Pfandbrief market, which provides for financing around a certain structure, around a certain base, in a sense, come what may. So it was, always is there, always has been there. I think probably always will be there. So that kind of gives a baseline of lending for a certain type of assets, albeit reasonably narrow, but it does provide a baseline. I think the second thing is just the number of banks in Germany, and which has two effects. I think firstly, Germany is on the one hand, I suppose, to some extent overbanked, and there's probably an argument for having less banks in Germany, but I think on the other hand, the UK is actually underbanked. So when you look at the marketplace in the UK for financing, it's very, very much seems to be often without rhyme or reason. One deal gets financed by somebody, and then at the same time a deal which one would have expected that that same person would finance with their eyes shut, they pass on, or they won't even put a term sheet out on. We saw this very, very much over the summer. We were involved in advising Citigroup on their acquisition of the Postbank portfolio in the UK, which contained a huge variety of different assets by size, type, quality, location, usage, and so on. And part of what we were doing is pricing where refinancing would come out, where and even if refinancing would come out on a lot of these assets and loans, essentially. And for some of them, it was extremely difficult. Whereas, again, in Germany, there are a number of people to go to for a deal which more or less fits.
Interesting. So, again, plenty of money out there for the plain vanilla lending.
Whereas here, there, in a sense, isn't, because HSBC sometimes is active, sometimes isn't. One never really knows. For example, Nationwide went very quiet. Are they back in business? Who knows? RBS seem to lend on, reasonably aggressive things, but not often on reasonably conservative things. And, again, Lloyd's is probably the one that's kind of been there most throughout the last 5 years, but Barclays is another one. But it's very much, they sort of dip in, dip out of the market. They have different targets at different points, but there's not really a sense here of kind of stability of model, I would say.
Thank you. So let's look forward now. Let's break out our crystal balls and think about what may happen. And if I may, Curth, start with you again. Your current barometer is showing a lending spread for senior lending of something like 185 basis points. I think 6 months ago the barometer was saying something like 200. So we've seen some compression. As you look forward over the next year or two, is more compression coming? Also, what do you think may happen as rates normalize as we get into a tapering environment?
I mean, it depends on the specific situation. As you just said, as it is here in the UK, it depends on the specific situation whether there is compression on the margins or not. I mean, clearly there is an increased competition financing core assets, or call them the similar deals there in prestige and prime properties and core locations, there will be compression. And due to the competition between just the German banks, what we are seeing is a decrease in margins, which not only shown by the barometer, as we are covering the whole market with the barometer, but in terms of when it's getting more, let's say, difficult in terms of different locations or niche products, asset types, as we heard here, like hotels or similar, there we wouldn't expect a decrease in margin, more or less a stabilized margin, or maybe new entrants, an increase in margin.
So maybe some compression for the really easy stuff, maybe not for some of the more complicated.
Exactly.
And spreads at the peak of the market were more like 80 basis points?
I mean, we've done deals in the boom years. I can tell 100% senior debt LTV at 80 basis points. This was the reality.
So as the Federal Reserve and the Bundesbank and the ECB start to tighten credit, and we see short-term rates start to go up at some future time, what's going to happen to spreads? Will spreads come down again? And what's your vision for how it?
I mean, we wouldn't
unwinds?
expect that the spreads are coming down immediately just due to that fact. From our point of view, it's a question whether the liquidity or where the customers are coming from, who are maybe buying the bonds or who may be buying the Pfandbriefe. This is more or less the question. And when it's coming to, let's say, 60 or 65% gearing, what about the new entrants, the insurance companies, the pension funds, or the superannuation teams, whether they have enough liquidity and who can simply refinance themselves?
Okay. Michael, can you share your view about where you think spreads are going, maybe briefly for senior lending, but more importantly, over the next couple of years? You're telling a very interesting story about attractive returns. You're telling the story publicly. So do you think you'll have more and more competitors over time? What's your crystal ball say?
Well, first of all, I agree with Curth's views on margins on senior, and also on the mezz side. I don't see them contracting too fast. There will be new players in the market, but in the moment, especially in Germany, there are not as many fishermen sitting on the lake like in the UK. So there's still enough space for new starters. Regarding margins, if the ECB starts tapering or quantitative easing will end, well, if interest rates rise, that means that on the other hand, that availability of financing is lower. And if the theory is right, then prices shouldn't go down. So therefore, I'm very relaxed on the question of sinking margins.
Okay, Matthias, is there any scenario out there that we should be worried about? Obviously, we've gone through a really, really tough time, and I think what we're hearing now is quite a positive tone. But is there anything out there that makes you worry that some part of this relatively calm story right now could come back to bite us? What worries you?
If I knew, I probably could stop working as a lawyer, probably. I don't know. I mean, I personally think there are a lot of risks still involved in the market. I mean, if you read about all the derivatives sector, for example, $1 trillion of risks somewhere lying with the banks. And but I feel that it's a little bit like an environmental disaster. Out of a sudden, the environment recovers and nobody knows how it went. So I'm not sure. I can't tell. But I think everybody should be aware of the situation where we were a couple of years ago. And we all experienced that theoretical risks have materialized and in 2008, 2009. And probably nobody will forget that. And I still think that there are not only theoretical risks still in the market, but also practical risks. And but I think that people are not aware of that anymore as they were before. But it's natural, I guess, and perhaps nothing happened, and we still work on it. Everything is recovering very well. So I think it's difficult to give a statement.
One thing that worries me is if you think about where all-in borrowing rates are today, they're at such a low level, and it feels like a lot of the financing is being done on a 3-year basis or a 5-year basis. I know, Matthias, you're involved in a lot of transactions. As you deal with your clients and you think about financing, does it worry you that so many are choosing relatively short maturities, and does it worry you where rates might normalize and where the owners might be, as we get closer to refinancing?
I mean, yeah. I mean, there are tremendous refinancing needs, despite of the real estate market in Germany. If you think of all the Mittelstands bond issuance programs, which will mature in the next 2 years. It's a tremendous market and tremendous needs for refinancing in Germany. On the other hand, the banks are flooded with money. So I think if it's just a question of getting the situation right, and we love situations as lawyers we work on, which we have initiated. But I think part of the work is to solve the upcoming problems and challenges by linking up the people who have available money for smart opportunities with these guys who are in front of these situations. And I think it's more a challenge of communicating, of transparency, to be which is needed to anticipate the solutions in the right moment. I think it's possible to manage that. But I feel that because of the last year's kind of re-nationalism, like Germany, a lot of German local banks are financing a lot of situations on German governed documents. It's a nice thing to have. But to cope with the upcoming challenges, we have to bring together a global approach to the market. As I said before, there are a lot of money in the UK and US sitting there, and I think that's the main challenge, to link them up with the financing needs, which are quite specific in Germany, and I think it's true for other countries as well. As I said, for example, give you an example how the market is different. We have just recently advised on transaction for a Bora Treveria portfolio, you may know, which is a quite challenging one of value of 1.1 billion. And the different parts of this transaction, of this overall portfolio, showed the different spectrum what we have at the moment. There was one side which was no problem to get a refinancing with a bank in Germany of about almost 400 million euro. They were not worried at all to syndicate that and to manage to provide financing. On the other hand, we have a distressed part of that portfolio which went into insolvency. And in the middle, we have a kind of competition by hedge funds, opportunities funds who urgently wanted to get into the situation. Why? Because they got a nice portfolio with a devaluation of, say, a discount of 50% or something of the original value. That's attracting to them. But we have a lot of transactions and portfolio situations in Germany which are not fitting in these three categories. And then it's very a challenge to find an appropriate solution, financing solution for these situations.
Sounds like there's some interesting opportunities there to find investments that don't fit in the normal buckets. Jesse, if I may, a quick question on the listed market. So you've convinced us that it's large. You've convinced us that it works for resi. Is it going to work for commercial?
I'm a huge optimist and believer in capital markets. So I think that, given what we've seen on the debt capital market side, again, exclusively in the resi space, but what we've seen recently is that there is huge interest for German property. I don't know that that's exclusive to residential, but that there's huge interest in German property as the low yield environment stays low and people are looking for yield. So I think these oversubscribed CMBS issuances that we've seen recently, yields that have come down from the first GAGFA issue was at 335, come down to 271. is testament to, well, the success of the recent past, but it's also a little bit of a midterm outlook. So I would not be surprised to see increasing volumes in debt capital markets for residential as well as commercial. That to me is possible, probable. Looking at equity capital markets, and I think here you have to focus on the residential sector even more. Looking at equity capital markets, you've had a wave of IPOs, of a lot of capital issuance, and the stocks have run a lot. So I think from the perspective of a crowded marketplace, of incremental demand for residential names, I would say we're at critical mass. Investors are significantly more selective, and I don't know that there are a lot of these big round one deals left to do. Now, GSW, Deutsche Wohnen are coming together. You've had the big IPOs. From my current vantage point, I can't see a whole lot of more residential market cap at the margin. Yes, but capital increases. I don't see so many IPOs on the near horizon. On the commercial side, by contrast, I think there's a lot of investor demand and has been a lot of investor demand. So I could certainly see a lot of opportunity for privately owned, corporate owned, fund owned properties to migrate from those markets, from those vehicles into public markets, especially if the vehicles like the German open-end funds are impaired, and especially if law is mandating that you mark down those assets. So I think over time, medium term, we could certainly see some migration of assets to the public listed space. But looking near term and thinking about capital markets readiness, what we tend to tell our clients is don't try to force your way onto capital markets. Get your house in order first. Think about corporate governance. Think about capital structure. Think about investor communication. Then address capital markets. Forcing your way onto capital markets with high leverage or an impaired structure doesn't work, or usually doesn't work. And I think we can point to the 2011 Prime Office IPO. That in many investors' opinions was too hasty. You can look at other companies whose leverage has crippled them. I'm thinking about Eurocastle, for example. So from the perspective of near-term capital markets additions, equity capital markets additions in the commercial space, I would say there's not a huge commercial space-driven IPO wave that I envision. I could see a recapitalization here or there. I could see a merger here or there. But I think, to see that IPO wave that's akin to the resi space that we've seen more recently, I think we have a few bars of homework left to do.
Charles, do we have another couple minutes? Or yeah, so just very, very briefly, panelists, best idea. So if you're an investor, where should I put my money? If you're a borrower, what's the cheapest way to get capital? Just very briefly, maybe starting with Michael, and I have a feeling I know what you're going to say, but...
Well, given the fact that markets have run for a while, I would feel very much more comfortable on the defensive side. So I think the smarter way to invest in real estate is through debt in the moment, to whatever risk spectrum. But I think that is a good way to invest in the moment.
Thank you. Matthias?
I agree. It's probably because I know the instrument best, but I agree that that instrument is a nice way to do it, in particular in special situations where you have a healthy target, but it just run into some liquidity problems because the traditional banks withdraw due to a covenant breach or something that's similar. And if you pick these and go via debt into these, and maybe you get a nice second lien or something on this, even secured, I think it's the best way to invest right now.
Thank you, Jacob.
And I'm honestly not paid to say this, but I like Michael's model because it's size-wise, it's niche. Plus, unusually for debt investments, it's kind of it's event driven rather than being just sort of market directional like some of the NPL trades.
Curth?
Clearly, debt investments. I mean, we're seeing a huge opportunity for whole loan providers, meaning for those who are providing senior and junior, or call it senior and mezz, as one party to avoid any structuring conflicts.
Interesting. And Jesse?
Yeah, I've got to contradict all of you folks. I'm sorry. I would suggest my best idea is use capital markets to re-equitize while they're open. And that does not mean that there's not a role for debt capital markets. You know, debt capital markets probably will always be the most significant part of the capital structure, no question. But you see with the virtuous example of Deutsche Annington, here's a company who was able to use capital markets, both debt and equity capital markets, to bring down its leverage from unsustainable 84% to, for German standards, quite moderate 50%. And by contrast, you have a couple of other players out there who I think are doing more of kicking the can down the road. So, remember the nail-biting situation of 2011 and 2012 when we all didn't know if this wall of CMBS financing was going to be met. Those days are now behind us, but they're not far behind us, and they could lie ahead of us. So use capital markets to get the equity when you can.
Thank you. Do we have time for questions or no? Any one or two questions from the audience? No? Thank you. If you please join me in thanking our panel.
Yeah.